Hey guys, Ken Boyd with the Accounting Accidentally website, where if you slide down in the middle of the page, you'll find over 400 links to my YouTube videos on accounting and finance, and also the blog posts you'll see up here. Also have now the Patreon page where you can get subscriber-only video content. So we're approaching tax season as I record this, and I want to talk about some of the basic tax returns, starting with the form we all fill out, which is Form 1040 for the individual taxpayer. So how does the form work? I'm going to split my discussion between page 1 and page 2. We all fill out these in software, and it's very difficult for people to understand what's actually going on. So here goes. We start off with income sources: wages, interest income, dividend income, maybe rental income if you rent property. And then we subtract the standard or the itemized deduction. We take the larger of the two deductions. I'll talk about itemized deductions, which are in Schedule A in a separate video. And what that equals is, the difference is taxable income. So here is the meat of page 1 of Form 1040. We have wages and a whole bunch of other income sources: IRA distributions, taxable interest, ordinary dividends on stocks, capital gains and losses. I'll talk about that later. And it all rolls up into an income total. We take it down to adjusted gross income. Now you'll see it here, we have adjustments to income, which I won't go into in this discussion, but we have AGI, or adjusted gross income. And we subtract from adjusted gross income the standard or the itemized deductions. You see the standard deductions over here. If itemized or larger, you take the itemized, and we come down to taxable income. That's page 1. Page 2, this is where we calculate the tax on that income, including self-employment tax that we'll see in a minute. And I want to make a distinction between tax credits, which are in this section of Form 1040, and a tax deduction. A tax credit I describe as like a gift certificate from the IRS, because a $1 tax credit reduces your liability by $1. So if you get a child care tax credit, for example, that's a 1-for-1 reduction in your tax liability, as opposed to a tax deduction. So if you have a business expense that is a deduction, or a mortgage deduction, that deduction is multiplied by the tax rate. It is not a 1-for-1 deduction your liability. So a tax credit is more valuable than a tax deduction in terms of lowering a tax liability. So we take tax, we adjust for credits, less what was paid in. Well, you either withheld taxes on a W-2, or you paid in estimated taxes, or both. And the result is you either have a tax refund, you get money back, or you have a tax liability. So here's page 2. We start with taxes at the top. You see credits here in the middle, including the child tax credit. Here's the tax for self-employment on line 23. If you're self-employed, that comes from Schedule C. We get our total tax. And then we start adjusting for withholdings. What was on W-2? If you were a 1099 employee, it's unusual, but maybe somebody withheld tax. What estimated tax payments did you make every quarter? We adjust from some other credits, and we come down to total payments. And the taxes, less the total payments, leaves you with a refund or an amount that you owe. So that is an overview of the Form 1040. And I wanted to remind everybody that you can go to my Patreon page, Accounting Accidentally. You can join, and you can get subscriber-only videos. Thanks so much for watching, and we'll see you